So it's important to understand how things will shape up going into the remainder of the week. And Geoff Dennis, who's head of global EM strategy at UBS, joins in to give us just that perspective. Geoff, good morning. Thanks very much for speaking with us. We really appreciate you staying up for this phone interview. What's happening? Do you think that that shock is done and over with? Do you think that the markets would stabilize from here?
Yes, we do think the markets will probably stabilize. We feel very strongly that the trigger for the market meltdown in the U.S. was the wage data in the January employment report. I'm sorry, which came out on Friday, and raised yet more fears about rising inflation, pushing bond yields up. And I think that was the trigger for the heavy selling on Friday. We got some more strong data on Monday, and I think that it was the macro that was the trigger. But of course, the selling was made considerably worse by technical factors. People who had basically been selling volatility, which had been so low for some time. You got a lot of people who had to clear out of positions, and it was extremely technically driven in our view. Nothing happened today, I think, to actually particularly turn around from a fundamental point of view. But I think the market was showing signs as it started to begin to stabilize that it had oversold. I mean, the U.S. market was down 8% from the high on the 26th of January, or nearly 8%. That just was too much of a move for this modest increased threat of inflation. So we think the downside was very technically driven. Clearly, the upside rebound has been technically driven so far as well. But we tend to think the worst is over here. And although it will take time to rebuild without any question.
Right. But, on that wage inflation story, do you think that inflation, the fear of that is real? Because the Fed has not come out and, expressed any alarm bells with regards to how rising inflation can change their plans on hiking rates this year. They're still committed to 3 rate hikes, and it doesn't change the dot plot that they've laid out already.
No, I think that's right. But certainly the last FOMC statement was slightly less dovish, perhaps, or slightly more concerned at the margin about inflation. Of course, as we all know, the unemployment rate's so low, it's inevitable the Fed is watching that relatively carefully. Now, you wouldn't expect the Fed to react to one number, as they say, the wage inflation number, the earnings number on Friday. And also, you wouldn't really expect the Fed to say anything about the market decline unless it was really more dramatic and more sustained. And as your listeners will be aware, of course, we also have a slight other wrinkle, which is that, of course, it was Jay Powell's first day on the job yesterday. So I think there's a lot of things going on here, but you're right. We don't think that there's enough on the inflation front to warrant more than 3 interest rate hikes at all. And we had that view before Friday. We have that view now. I think the market just faced up a bit more to the inflation threat, started to sell off. Then the technical factors kicked in. This thing was way overdone. We think the global economy is strong. We think the earnings story is good. And this is why we think we've probably passed the worst, and investors, probably see a chance to buy here.
Dennis, I have a very simple follow-up question. If risk in the world is unwinding, then what explains commodity prices are still holding on? Because historically, what my experience is that when risk is unwinding, everything comes under the butcher block.
I think that's a really good question. We've actually made the comment this morning in a note one of my colleagues put out, that was remarkable about yesterday's events, Monday's events, was that the rest of the financial asset classes really didn't have much of a reaction. Of course, bonds rallied. You would expect that, a flight to quality, but they didn't rally that much, frankly. The dollar was a little weaker, not that much weaker. Commodity prices broadly held in. And I think that just confirms my story, if I may put it that way, because our view is that this was an equity market reaction to a bond market move that triggered all this excessive technical action within the equity market. And the fact that it was contained within the equity market broadly really tells you, in fact, that, yes, indeed, this is largely a technical event and is not, as you say, I don't think it is a global risk-off event at all. I think it's an equity risk-off event, and I think the rest of the markets have stayed calm, as they should do, in what is still a pretty good environment, we think, for the global economy.
With one more point, I mean, I'm taking the extreme bullish side here. We've not seen too much of collateral damage in emerging market currencies as well. So it clearly means that global investors and traders know that global growth is real. And once this so-called technical adjustment is behind us, it really could be back to winning days. So Mr. Dennis, the point I'm trying to make here is that it's not that everywhere there is gloom and doom in the world.
No, and I absolutely agree with you, and that's pretty much what I said. That I think this will prove to be, an opportunity, and we have a fairly constructive target out there for emerging market equities for this year. But to tackle this specific point, if the dollar is not rebounding, not rallying much on the back of the equity market move, you really wouldn't expect to see emerging market currencies go down much, and indeed they didn't. I mean, there was some selling yesterday of currencies like the Brazilian real, for example, came under a bit of pressure, the South African rand, but generally it was minimal compared to other quote-unquote crises we've had in the past. And once again, the limited action in EM currencies simply confirms our view that this is an equity event that was taken too far from a technical point of view, and it was set against the background of pretty good fundamentals.
Mr. Dennis, appreciate your time and thank you for joining us. And Tanveer and Siddharth, this is the point I just want to make. It sort of struck me when I looked at the data in the morning that, we've got trillions of dollars of market cap which has got eroded, both for Dow and even, other emerging markets. But if there was a financial Armageddon, I'm using this word Armageddon strongly because I read on some websites, yesterday morning, yesterday evening that, oh my God, a financial Armageddon has started and it's time to just take cover, then the sell-off would have intensified in emerging market currencies, and the sell-off would have also intensified in commodities. The reason why commodities and emerging market currencies so far have not really seen a crunch is because somewhere markets know that the growth which we've seen, global growth what we've seen, is real. And if that is the underlying view, which is that if global growth is real, then commodities may not backfire that much, and then emerging market currencies will look stabilized. I mean, whatever I'm saying is subject to change depending on the data, but as of now, today, the data makes me believe that this is more like a technical event which has been restricted to equities, and it was being sparked by selling in bond yields. Frankly, if you look at bond yields moved to 2.7% 8-10 days ago. And markets were due for a correction, and we are trying to find all the linkages. But if for me, the global scare would have been if crude would have collapsed, if commodity prices would have come out, if there was a rout in emerging market currencies. Everything is connected. It could happen. But as of now, today, that is what markets are telling you, that look, this is a technical event restricted to global equities.